So this is a topic that has been on the minds of all the panels and startups that we've had so far, and that's governance models. This to me is just a fascinating topic, and to me, one of the questions that I find central is what does it mean for these protocols to be community owned, and this idea of protocol politicians, or a professional class of people that would represent people's interests in the community governance of a particular crypto protocol. I think it's just one topic that I find interesting, but I'll leave it over to our panelists to tell us all what we really should know. And that's going to start with Will Peets, who is the founder and CIO of 100 Acre Ventures. Will.
Great. Well, thanks, Nick. Yeah, I mean, you did a good job of already providing kind of an overview of the topics for the panel. I prepared some brief notes, but the panel itself, titled "New Corporate Governance and Ownership Structures." In the traditional corporate structure, the main function of governance operating models to organize operational, financial, risk management, and reporting processes, so that the board can receive the information it needs to put together a good governance into practice, and business units can conduct their work in compliance with regulation and strategic goals. And so very dry, but the idea here is that we're moving a lot of that, on chain. So in crypto economic models, you want to embed these governance and incentive mechanisms directly into the code or to the protocol itself, and with hopefully not too much reliant on the team and the founders behind these. But that's a topic that we'll get into a lot today. And so to kind of provide a brief but more formal definition of what we're talking about with crypto economics. This is from MIT's Crypto Economics Lab. Crypto economics brings together the fields of economics and computer science to study the decentralized marketplaces and applications that can be built by combining cryptography with economic incentives. It focuses on individual decision-making and strategic interaction between different participants in a digital ecosystem. So these are the users, the providers of key resources, application developers, and uses methodologies from the field of economics, such as game theory, mechanism design, and causal inference to understand how to fund, design, develop, facilitate the operations, and encourage the adoption of centralized marketplaces and related services. So these resulting digital economies need effective governance to ensure that the platform maintainers can upgrade the underlying software protocols over time in response to change in the environment. So again, very wordy, but I wanted just to provide some kind of context of what the objective, of these governance models are in the context of digital assets and crypto economies. So today I have three great guests with me, each of which we could spend probably the full 45 minutes talking to, both coming from the kind of creator and builder of these protocols, as well as people who've invested and acted as active stewards into the protocols themselves. So hopefully joining us, we're still waiting for one attendee, but Stani Kulachov, who is the founder and CEO of Aave. This is a leading blockchain startup focused on decentralized lending, with now over $4.5 billion in assets on the protocol. We also have Spencer Noon. He's the general partner at Variant Fund and creator of Our Network, which is a crypto analytics newsletter. We also have Liz Kukka. She's the principal at Digital Finance Group, a global blockchain and digital asset investment firm with assets in excess of $550 million. So again, a great panel with, again, perspectives from kind of every angle here. So I want to kind of jump directly into these different governance and ownership models, crypto versus traditional equity, and kind of discuss the different roles of stakeholders. Spencer, one of the kind of key thesis at Variant Fund is this notion of the ownership economy. And so just want to get a sense from you, like what constitutes an owner in these new crypto economic models? How does this paradigm shift fit into the ownership economy?
Yeah, I would say, and by the way, thanks for having me and moderating. It's pretty simple. I mean, anyone who is an economic agent in one of these new protocols is what I would call an owner. But probably more specifically, someone who owns like the underlying governance tokens that own and that users own and operate with these systems. So to like maybe make that a little bit more concrete, In a DeFi protocol, decentralized finance like Aave or Compound, you have basically a number of tokens that are issued similar to like Bitcoin or Ethereum or any other crypto asset, but these tokens have specific rights for their owners to you know add and change and remove different rules and set parameters to how those protocols are run. And so you could imagine like, different fees, revenue streams, and other things kind of being governed by them. And this is like a fundamentally different paradigm than how like a company is structured, right? Like governance with regular companies, you have board stocks, like this whole massive legal paradigm. This is really code is law. If you own the token, you're able to enact change on the token within like a kind of specified framework. And we can get into that in a bit, but yeah, user ownership is like this totally new thing.
And just maybe to dig in that a little bit, you said within a certain amount, but within, you can influence the protocol or things that happen in the protocol within kind of certain bounds. I think that's in part dictated by how the protocol was designed itself. There's clearly kind of a big role of the founding team in many of these. I guess, Liz, have you seen examples of protocols that you've invested in or worked with, where there's, a particularly a good balance between, what's able to be done through the kind of on-chain governance protocol, versus what requires still kind of the team itself to be, very influential and involved?
Yeah, well, so first, thanks for having me join as well. I think similar to what Spencer is saying, this is just to kind of piggyback off that a little bit, that in Internet 2.0, which is oftentimes what we call blockchain, right? It requires new products, services, and new approaches to how we think about business and ownership, exactly as you just said. So I think one team that's doing a pretty good job of this, mostly because it's a team I know that it's actually happening. It's not just the white paper, and it's not like, and you can't tell when using a platform what's happening on the back end. So this is a team that I've actually interacted with enough, not as an investor or a token holder, but that's LivePeer. And so I think LivePeer is a pretty good example of this. They're essentially disrupting the world of broadcasting, and having to pay high fees for audio and video streaming. And the way that they're structured is that they have a B2B component where folks want fast streaming, and those folks don't know anything about the blockchain or crypto world and don't have to participate in it in any way, shape, or form. And then they have a token economy, and that's the folks who are essentially freeing up their compute or their bandwidth so that LivePeer can then stream that or share that over to folks who need it. And they're compensated for doing so. So it's really similar to mining. It's a really similar concept, except for instead it's for video streaming. And instead of validators, they have transcoders who are essentially helping get the video into bite-sized parts that can then be used on different devices based on their requirements. So anyway, they have this entire pretty neat economy that's working. They're on mainnet. They have a couple of customers, and they really are living up to what they're saying that they believe in, which is a democratized ownership of this service. Hopefully that made sense.
No, it does. And, I think something that of course is reoccurring in all of these governance models is, the role of different stakeholders within the ecosystem, some of which who are being stewards of the network, others who are providing direct resources to the network, and the protocol being able to effectively balance how these different parties are incentivized in a way to, perpetuate the protocol into the future. I guess, on that specific note, both of you have invested extensively in various protocols. I guess, how do you each think about, maybe we can start with you, Spencer. How do you each think about your role as you invest in these protocols directly, in terms of how involved you should be, and basically what you can do as an investor to kind of influence a project in a way and really kind of help drive its long-term adoption and success?
Yeah, for sure. So and maybe I'll just give a little bit of background on Variant too, because it'll probably be helpful. But so at Variant, we're kind of investing against this thesis called the ownership economy. And the basic idea is that when you have software platforms that are owned and operated by their users, there is the potential to just have better incentive alignment and just way better network effects. And so, like the number one case study for this is Bitcoin, right? And Ethereum is probably a good one too. But Bitcoin is a $1 trillion store of value asset that is kind of used across really institutional finance today, and it's quite remarkable. And I think most of us in this industry would all say to ourselves, there is literally no way that could have happened without the just incredible community effort from the Bitcoin community, right? And I think the idea is this model applies to and can apply to much more, many more different types of software. And so we kind of see precedent with that already. Like some examples that come to mind, Uber and Airbnb, they've already petitioned the SEC to allow for their gig economy workers to receive equity, right? And kind of be financially incentivized in the growth of their platform. But unfortunately, it's just not enough, right? There needs to be, or at least we at least think this way. There needs to be more and just greater alignment. And so, all these different economic agents are going to be governing systems. It depends on what type of app it is, right? Layer one, layer two, app, whatever. But I think there's this idea of progressive decentralization. You can't just throw something out there into the public and be like, it works, right? Like go off and now create billions of dollars. It's still a startup at its core and needs to be kind of crater or catered to over some amount of time, and then it's ready. You have this code and you can kind of unleash it to the community and have the community operate it. And so when we're investing, we're typically at the pre-seed and seed stage, and so we're working with companies that are building these, and at a certain point of time, it could be a year or 2 years or even longer. That's when they progressively decentralize. They add a governance token, and they let everyone else kind of start governing. Um, so yeah, I think there's like so much to get into with this, but it really is this, like I was saying before, a completely new way to like build a company.
Yeah. So I'm going to come back to you on this concept of progressive decentralization, and also kind of the incentive specific in some of these governance tokens. But wanted to give Liz maybe an opportunity to answer the same question in terms of how you think about your role as an investor, because I think when we were chatting about this, prior to the panel, you made the comment that, or I'll paraphrase, capital has kind of been less of a scarce resource, specifically recently, coming into this space. And unlike in a traditional venture fund where you might, sit on the board and you can use your network to help, the company get new clients, there's a very different paradigm here. And so kind of how do you think about your role, when you're investing directly into these protocols and these founding teams, and how you can, add value, or what you even think investors should be doing to add value?
Yeah. So before Digital Finance Group and Ethereum Classic Labs, I was at Plug and Play Tech Center, which is a global accelerator program where I worked with hundreds of startups and investors and so on and so forth. And I don't really see my role being any different in supporting a startup within the blockchain crypto ecosystem as I do in insurtech, fintech, enterprise 2.0. I don't really think it's any different at all. The only difference is understanding kind of the philosophy or values behind it, or the change that people are trying to make. Like that is definitely different, but otherwise it's all the same. So helping with fundraising, helping with customers, helping get users onto the platform, helping find speaking opportunities, working on pitch decks. Like, I mean, all of that's exactly the same. There is like literally no difference at all. The only difference is that you're kind of speaking a different language, or your approach to business is just different, and that you're trying to democratize ownership. And so that is different. And I think during our chat, something we had talked about is that a lot of startups that I know, they only want to work with folks who are purely crypto blockchain. So that's from accounting, that's from legal if possible, that's investors if possible, and really just want to broaden and strengthen this ecosystem. Again, as Internet 2.0, just like Lyft and Uber came in and disrupted Yellow Cab could have put out an app. Yellow Cab could have done all of those things that Lyft and Uber are doing, but they didn't. They didn't do it fast enough. And I think blockchain's really similar. There's a lot of innovation happening in blockchain that you could say, is this just a workaround? And to some degree, maybe so, but it's really just things are happening way too slow. And so people are demanding, democratization of ownership, transparency, and interoperability amongst platforms. And so those are the major differences. And folks want to support others who have that same vision.
Yeah, and maybe one thing I would add is, and I generally agree with that. Like there are just so many similarities between kind of early stage Web2 companies and what we see in crypto. But perhaps like an added axis is just this idea of community building, right? Like if you want to have a decentralized network, it has to be sufficiently decentralized. And what that means is, that there's not like a key, person or team or third party that controls um, all of the funds or the economic activity or what have you. And so I kind of look at this as an emerging discipline, and it's something that we think really deeply about at Variant, which is like, how do you go out and find market makers who are willing to provide liquidity for a protocol, or independent analysts who want to monitor the network health of how a new platform is doing, or someone who wants to make memes. Like really, it could literally be anything. All of these things are like comprised of a healthy community, and so I think that is an emerging discipline that we're all kind of figuring out.
So one topic that you brought up is this idea of progressive decentralization. You mentioned it needs to be sufficiently decentralized, but there is, at least definitely at the offset, and we're seeing. Well, we're watching this happen in real time, so we'll see how these things progress. But like in the case of Aave, Stanny's a key figurehead there. Uniswap, Hayden's a key figurehead there. And so how do you, I guess, both from the investor hat, clearly early on you're betting on a team, you're betting on them to be able to build the community, build V1, V2 of the protocol such that it kind of meets all these very specific requirements. Kind of how do you, I guess, A, view them in the context of your initial investment, but B, view their role on a going forward basis such that, the protocol can continually be successful, with or without their kind of involvement? I know that's a very question, but
this is really it's a little bit of a moving target. And I would say like best practices is like changing, and it depends on your interpretation, right? I think we all kind of agree that if, Stanny is the one who created Aave, wouldn't it just be great if he was working on it all the time and like pushing changes and doing all of those things? That's frankly like quite aggressive, I would say, in terms of what I see as best practices. Generally speaking, what we see is we have a team that will build a version of a protocol. And so it could take them a year, it could take them longer. They'll put that out into the open. And then at that point, they no longer do any work on that version of the protocol. If they do more work, it's on a version 2 of the protocol that needs to be deployed at a later date, independent of kind of like the community efforts that are happening at that time. And then importantly, the decision to move to that new version is not predicated on what the team says, but on the original V1 governance holders who are owning those tokens. They have to be the ones to make the decision that say, we're going to that version 2. So, yeah, some nuance here, but like, I think it's really important that people understand these things are basically machines, and you can't just, have someone changing the gears while the flight is kind of mid-flight.
Right. I don't know, Liz, any thoughts there in terms of just your expectations around kind of the founding team and the necessity for them to be continually involved in, again, what's intended to be a, decentralized, distributed governance network?
I think it depends if it's a token distribution or if it's equity. I think that plays a part. And if it is going to be a token structure where it eventually will become community owned and operated, I think as an investor, you just want to make sure that your agreements are held up, right? And so if that means that you're getting tokens at a 30% discount, then that's happening. I guess without going too deep into this, I would say just get the terms you want in place in advance, and maybe there's a few different representatives who you can check in with. I think when it comes to tokens and community ownership, though, it gets pretty tricky, but I agree with what Spencer is saying. And I think in traditional companies as well, like the CEO is not the product person, not usually, or they probably shouldn't be. Like they might have the initial concept, but eventually you should probably hire somebody to lead product. And I think to listen to your community members who are probably more ear to the ground than you are, probably do have a good sense of direction. So I know it's a new way of managing investment and how to look at investment. And again, I think it just depends if it's tokens versus equity.
Yeah. Okay, we'll come back to the tokens versus equity piece. But there's a lot of things that stand out in this conversation that I think, frankly, probably make it difficult for people who are new to the space to understand how to approach it, particularly as an investor. I mean, one, Spencer, you mentioned how, in some cases, the protocol is this infrastructure, and then there's a governance token that sits alongside of it, which means also that you can, fork the infrastructure and clone it and create some other incentive mechanism to use, basically Uniswaps, or Sushi Swap or the next AMM, or alternative lending protocols. And so it does kind of call into this question of, again, the role of the founder and the community that they've built in creating effectively a moat around what, again, is a infrastructure that is publicly available, sits on GitHub, you can fork. So I think that is again, a moving target, but an interesting element of this space.
Yeah. No, I think so I've been investing in this space for a long time, professionally for over 3 years. And typically investors like me love to get into this awesome theoretical vacuum of the chess moves about what could happen over time if, different protocols are forked, and why can't someone just take the code that's open source and just do it somewhere else? I think when you really get down to it and see what's happened in practice, it's so much harder than the theory, right? Like anyone can take the code and move it over and deploy it and even attract liquidity. But to do that sustainably over a long period of time is we found it to be almost impossible. It's very difficult to say the least. You have examples like Bitcoin Cash, BSV, some of these really early examples, Bitcoin Private, that had some hoopla and then immediately kind of fizzled out. And in DeFi, we see these, they call them food coins, which are basically, you take a credible project, you fork the code, and for the logo, you put an emoji of a piece of food, and you play a game with them, and hopefully it works out. It's interesting though, because the one protocol that has kind of done this, that has stood the test of time, is one called Sushi Swap. And I think it's a really interesting case study because they originally forked Uniswap's code. And so people, I think, thought this probably isn't credible or defensible long term, because what happens if something needs to be upgraded or changed, or there's a problem with the smart contract security? You don't have that confidence that you do in the original Uniswap team to help the community find a solution. But over time, Sushi Swap has really, I think, proven themselves. They have a strong community of developers and technical people who have not only assuaged my concerns about that stuff, but also are building a differentiated roadmap to Uniswap. So they're doing just other things that isn't within the scope of the original Uniswap vision. And so, yeah, it's really fascinating to kind of see what happens. But yeah, we're getting all these examples and case studies in real time.
Yeah. So just to summarize, it's very difficult to do, but it's possible to do. So as an investor, you still need to think through, again, to your point, kind of how the chessboard looks and the different ways that it could play out. But from practice, what we've seen is several of the kind of leading protocols continue to get, more adoption, more traction, and call it network effects and building a moat. Although, again, it is possible for someone to come in and clone / partially differentiate themselves and become quite successful, like you mentioned with Sushi Swap.
Yeah.
So before I get to the token versus equity discussion, I do want to kind of touch on a little bit on the incentives embedded in a governance token, again, from the seat of an investor. So I think both the case of Aave and with Uniswap, there's this idea that governance token holders will be directly compensated, right? So in the case of Aave, they have this security module. Right now, the security module participates in distribution of additional Aave tokens, which is a bit recursive, but we won't get into that element of all these designs. But they're also, at some point in the future, we'll see, I think, a portion of the fees generated by the lending protocol itself. Likewise, with Uniswap, the idea is in the future portion of the swap fees will also be distributed to governance holders. So the protocol itself is going to reward, governance participants with kind of future cash flows. Is that, you think, kind of the main investment case for the governance tokens? Is this kind of convergence with a more traditional cash flow or distribution of value, or do you see that kind of evolving in a different route than maybe to going back to the token versus equity question? Are there certain classes of protocols where the token structure and design makes more sense versus maybe an equity structure makes more sense?
You want me to take it? Yeah, happy to.
I'm good at asking questions that have 12 embedded questions.
It's all good. So yeah, this is actually pretty fascinating. It actually kind of pushes some of my buttons of like what I see right now in the DeFi specifically, that community. And for people that don't know, that's like decentralized finance. It works on top of Ethereum. So governance tokens today allow you to govern these protocols, as we've discussed. But in the future, token holders should be able to code in, by this voting, different ways to capture value. And so the way that you could capture value, like Will said, is generally with some type of revenue share. And so there are different ways that is kind of manifested within a protocol. And I think it's really easy for Web 2 and kind of legacy, venture investors and other public markets people to reason about DeFi protocols, because they, in theory, in equilibrium, will have cash flows very similar to companies. And so you can value them. You can figure out what their price to sales ratio could be, et cetera, et cetera. The thing that I think is like pretty interesting is, right now in the community, there's this debate about whether protocols should be giving revenue to token holders right now. And if you think about it in the regular tech world, it would be totally ridiculous to have a 1-year-old company or a 2-year-old company distribute a dividend to their equity holders, right? They should be reinvesting those profits and growing their businesses even more. But there are a lot of folks in our industry who would prefer to have those like hard cash guarantees, which I find to just be, frankly, like a little bit backwards. But it's there are different protocols for everyone. SushiSwap is a great example of, Uniswap does not doesn't allow this like kind of disbursement of fees. SushiSwap does, and so that was like meaningfully differentiated in the eyes of their community. I think at the like base layer level with Bitcoin and with Ethereum, they are a lot more esoteric and kind of abstract to think about their value. It's not really cash flows. It's things like monetary premium and just like store of value and immutability. And so like we can't really use like a DCF to think about why the price of Bitcoin is $50,000. And I guess maybe to just wrap, even though these DeFi protocols look like companies, does not mean they should be structured as companies. Like they lose a lot of their kind of effectiveness when that happens, because they're in this permissionless environment that sits on top of Ethereum. And so we can go into that, be happy to, but yeah, some thoughts.
Yeah. So Liz, I mean, I'll let you, very open-ended question on kind of equity versus tokens. Is that kind of a philosophical debate that you guys have internally? Do you guys have a preference as investors, or does it really just kind of case by case? Does it make sense for kind of the objective of the company?
It's varied. I think in 2018, we were only doing equity investments. We were doing like convertible notes. And then last year, kind of middle of last year, and before that, we had made a ton of investments as well, right? So like Digital Finance Group has been investing in the space since 2014, 2015. So when I joined in 2018, mostly equity, 2019, mostly equity. And then last year, middle of the year, we really shifted hard back to tokens and are pretty much just doing token investments right now. Not only, like we invested in Polkadot's equity round. So it's not only token, but it's the majority. And I think it's a fair model. I think if you want more control, equity makes sense, but otherwise incentivizing your user base and your community and having rev share is a great way to to make people not feel like they're being used and getting burnt out. I mean, you see it on GitHub and Ethereum consensus all the time, right? Like that's what happened with a lot of developers feeling like they were volunteers, contributing a lot of time and effort to something that's greater than them and not being rewarded or compensated in any way, shape, or form. So that can only go on for so long. And so I think to compensate people for their time and effort and rethinking their participation to a company is really important. And so again, LivePeer does do it. LivePeer has a rev share model, which I don't want to go too in depth into like the structure, but happy to if folks want. But essentially, if I give up my bandwidth and compute power, I'm then staking it to like kind of like a validator who's doing the bulk of the work, like the DevOps person. And you would do a rev share with that validator and have a negotiation on what those fees are. But to speak a little bit to what Spencer had mentioned, I think maybe a question before, is what I really like about this as well is that those validators are creating a market of their own and are letting the market dictate their price. So they set their fees, but the market tells them if it's too high or low, and it's based on the quality of their work, the reliability of their work, the availability of their work, or like what they're providing. And so I think it's a really interesting new way to just think about contribution to companies and paying people for their time and value.
Yeah.
And Spencer, thank you. Web3. I can't believe this whole time you've been letting me say Web2.
Yeah, we knew what you were saying. I would add maybe a couple things. Yeah, I think some great points. For us as early stage investors, it's interesting. A lot of our companies end up having tokens, but we almost exclusively invest at that level in equity. And the reason is because it kind of preserves flexibility. They can always issue a token when they're ready to issue a token, and we have more governance as investors, right? I think in the like earlier vintages of crypto investing, if a project wasn't mature and you were just giving them money for a token, like in one of these SAFT agreements, a simple agreement for future tokens, there was a huge possibility that the team would not deliver the working network. And so we've kind of over time, smartened up, I would say, as an industry, and made sure that we have better guarantees. Once they are ready, though, I think we're seeing a lot of companies choose this path of issuing a token. One helpful dichotomy, I think, to think about this and like, should it have a token or not, is this idea of like crypto native versus not crypto native. So crypto native, I would say, is something that just spawns on a blockchain that does not require any collaboration with like the physical world, right? So Bitcoin doesn't have, banks that it needs to work properly, or legal structures, any of these kind of like human made things. But if you have something that does, if you have legal agreements, well, those can't be enforced on a blockchain. So a lot of the times it makes no sense for your project to have a token if you're going to be entering into like legal agreements with other counterparties. And also there's like regulatory problems with that too. But as Liz was talking about with LivePeer, there is this like new emerging category, I would say, of tokens, and that's, I would characterize them as like resource allocation protocols. So they don't necessarily need decentralization or censorship resistance or some of these other like hard guarantees that blockchains have traditionally given us. They're just a good way to like organize people who are distributed all over the globe to do like, data querying with the graph or indexing or what have you. And I'm actually really excited about new forms of resource allocation protocols, but it's kind of a slow burn compared to the crypto native stuff.
Right. Okay, well, we have a few more minutes here. I guess maybe just I think this is coming back to a couple topics around governance and kind of incentivizing people to participate. I guess, have you seen, on one hand, is there any risk in some of the large token holders who are the kind of the biggest contributors to governance of certain protocols and pushing in the wrong direction? I think, and generally speaking, you would say that their incentives are to, push the protocol forward. So they should be incentivized for it to succeed. But coming from the venture side and investing in these protocols is large funds holding kind of disproportionate shares of tokens. Has that caused any governance issues? And then speaking to Aave a little bit, Aave has an interesting model where well, people can delegate their voting responsibility. They can also delegate their promotion of new new initiatives to the protocol. But I think there's like this kind of general difficulty incentivizing those people to participate. So maybe beyond some of the revenue alignment of incentives, have you seen any interesting models that have really helped to kind of promote participation in governance?
Yeah, I mean, I think we see a whole class of like interesting models, and frankly, like one thing that excites me is like standardization. So Aave has created its own governance framework. Compound, which is another lender, has created the Compound governance framework. And rather than like spin up a whole new set of smart contracts to govern your protocol with, now new protocols can just fork those, right? They can just use what Compound has already built to govern their own protocols. And so, like in those, like Compound's a great example. They have this idea of delegating to other token holders to vote on your behalf, right? So if you're a venture capital fund like Variant, and maybe we're not experts in what the parameters of market making should be on an exchange, right? Like how are you gonna set some of these? Well, we probably want to just let an expert figure that out. And so we would find an expert and delegate our tokens to them and have them make the decision. So these are the different types of, I guess, coordinating mechanisms that are slowly being built out. But yeah, I think overall you have to have at a really like 1,000-foot view incentive alignment and just overall alignment with all of the token holders on the various like cap tables, if you will.
Yeah, and I like how
this won't function without it.
Right. And I like how it's easy, how quickly it evolves. You're able to see things that have worked, see things that haven't worked, embed them into your new protocol, include them into the V2 of your new protocol. Because when I was reading through some of Aave's kind of governance mechanisms, I can't help but think about just our traditional government, and you hire your representative of California, and he or she has to be an expert on all these different things that they'll potentially vote on. And it seems completely absurd when you just say it out loud. And then, in these new models, you have this ability to effectively delegate to, as you said, people who are experts in a certain component of that, structure, which hopefully, again, kind of reinforces, again, a long-term kind of viability and evolution of some of these protocols. So
yeah, and it's beautifully scalable too, right? Like Uniswap has, 10, 11 employees. They do billions of dollars in volume per day. Coinbase has, hundreds, thousands of employees. They do a similar magnitude of volume. It's truly crazy what you can do with kind of decentralized communities and smart contracts.
Right.
So I'm just really excited to see what happens
next. So I know Nick's jumping on here to give us some Q&A at the end, but my last question to ask is is there anything that you guys are really, really excited about that you want to highlight as kind of a leaving note for the audience?
I'll go first. I think we've been watching the NFT space for years now, and everyone thought they were going to come to fruition and be like this big hot thing a few years ago, and it kind of fizzled out and didn't really go anywhere, right? Like we all saw crypto kitties and then like nothing else. And it's in the news a lot, so it's probably not new, but I do see a lot coming down the pipeline in the NFT world. So that's interesting. And then in general, kind of what we've been talking about, which is just redefining ownership of companies and getting folks excited and rewarded for their contributions. So kind of different from what you see at Yelp and Facebook and Instagram and TikTok today, where we are the product, and instead folks kind of becoming the co-owner. So just to kind of wrap up with that same sentiment that's been going throughout this whole conversation. So happy to see it coming to surface.
Yeah, awesome. Thank you, Liz.
Yeah, and for me, you're definitely excited about NFTs. You're spending a ton of time diving into that space. I would say I'm most excited for the ability for these protocols that have launched to kind of wield the power of their treasuries. So Uniswap is a great example. They're kind of sitting on $9 billion worth of uni tokens. And the things that you can do with them, right, to incentivize new kind of liquidity provisioning or to help, fund research or different types of initiatives that ultimately help the Uniswap protocol is like so untapped right now. And no protocol is doing this, but everyone is thinking about it. And so when you put this in the context of like regular companies, maybe they have a couple $1,000,000 on their balance sheet, or they're like, day to day figuring it out, or month to month. But crypto, you actually have access to your entire supply sometimes, right up front. And so, yeah, I think it's going to be a great just case to see why you would maybe want to start a crypto company, because you have access to that versus the counterfactual.
Great. Well, guys, thank you both.